Hi, my name is Neethling. I am a credit analyst at 3CM. Today I'd like to talk to you about the South African bond market and more specifically whether we see any value given the recent sell-off in South African government bonds. But before I get to the actual valuation, I think it's important to consider why bond markets have sold off to the extent we've seen over the last few weeks. So, following the financial crisis in 2008, central banks around the world, and especially in the US, have injected excess liquidity into financial markets through programs like quantitative easing and the like. These programs were designed to stimulate economic demand by keeping interest rates low and thereby encouraging consumers to spend. What they've actually achieved is to distort market prices by artificially suppressing US yields and safe haven yields on developed market bonds. Investors have therefore turned to higher risk, income generating assets like South African government bonds in their search for yield. From the graph, we can see that foreign investors have stepped up their purchases on local government bonds and pushed yields to all-time lows over the last few years. Last year alone, foreigners were net buyers of around 90 billion rands worth of local government bonds and now make up a third of our local market. So recent bond market volatility is primarily attributable to two factors. The first is recent rand weakness, where foreign investors have borrowed money in developed markets or in offshore markets at low interest rates, and rand depreciation means that they now need more rands to convert back into their home currency. And the second is a pickup in US Treasury rates. The market effectively expects central bank stimulus to be scaled back at some point in time and starts to reprice for a more normalized environment, which includes higher US Treasury rates. So, turning to the valuations, we still think that bonds are expensive. Local government bonds are expensive. If we look at the graph, we can see that even at 8%, the yield on a 10-year government bond is only providing a real yield of around 2%. The average real return on the 10-year bond in South Africa has been about 3.2% after adjusting for inflation at 5.9% since 2000. So by simply using this average as our future expected inflation, we would require a nominal yield of around 9% on the 10-year bond to consider the market at fair value. So in conclusion, we do not believe that bond markets have normalized sufficiently to consider it fairly priced. The recent volatility does provide an indication as to what to expect once stimulus programs are eventually scaled back and eventually stopped. From our perspective, we are not forced buyers of bonds and are patient in waiting for attractive buying opportunities to arise in the future. Thank you.